Welcome to the Real Free News Podcast. Today, large asset managers control corporate America not by owning most shares, but by boardroom capture. This concentrated proxy power influences boards, CEOs, mergers, prices, wages, and even cultural policies across entire industries. The structure of corporate ownership in the United States and other developed markets has undergone a profound but largely unnoticed transformation since the explosive growth of passive index investing after the global financial crisis. Where once control over public companies required the purchase of a majority economic interest or the payment of a substantial control premium, it is now possible for a small number of financial institutions to determine the composition of corporate boards and therefore the strategic direction of entire enterprises, while holding only a minority of shares. This phenomenon, frequently described as boardroom capture or proxy voting power concentration, rests on the simple reality that the entity that reliably commands 25 to 35% of the votes at an annual shareholder meeting can almost always decide contested director elections and major governance questions. The mechanism is straightforward, yet extraordinarily powerful. Large asset managers, particularly BlackRock, Vanguard, and State Street, manage trillions of dollars on behalf of millions of individual investors, pension funds, and institutions through mutual funds and exchange-traded funds that track broad market indices. Although the underlying capital belongs to those dispersed investors, securities regulation and fund documentation grant the asset management firm itself the legal authority to vote the shares. A centralized stewardship team of fewer than 100 people at each of these firms therefore exercises discretionary proxy voting power over an ever-growing portion of the equity market. Because shareholding in most large public companies has become highly concentrated in the hands of the same few managers, their coordinated or parallel voting decisions have become decisive. This concentration has created a new form of corporate control that requires neither full ownership of the physical assets nor even majority ownership of the stock. A coordinated voting bloc that routinely exceeds 25% is typically sufficient to install preferred directors, approve or block mergers, shape executive compensation, and influence long-term corporate strategy. The result is a system in which a handful of financial institutions can direct thousands of ostensibly independent companies toward common objectives, whether maximum profit, expansion, environmental and social goals, or cultural uniformity, or any combination thereof, without ever acquiring the companies outright. This essay examines the mechanics, reinforcing loops, and broader consequences of that system as they have emerged in the conversations surrounding modern corporate governance. Part 1. Minority voting blocks as effective control. The traditional understanding of corporate control assumed that influence over a public company required ownership of more than 50% of the voting equity or, at minimum, a costly takeover bid accompanied by a control premium. Contemporary reality has rendered that assumption obsolete. In most U.S. public companies, shareholder turnout at annual meetings ranges between 70 and 85%, meaning that a disciplined bloc commanding 20 to 35% of the total votes is frequently decisive in director elections and significant governance referendums. The largest asset managers have reached or surpassed this threshold in the overwhelming majority of S&P 500 companies simply through the ordinary operation of index funds and exchange-traded funds. Once a block of this size signals a unified support or opposition, the outcome is usually predetermined. Boards facing the prospect of withheld votes from a quarter or more of the shareholder base routinely negotiate with the asset managers in advance, adopting the demanded policies on executive pay, climate commitments, diversity metrics, or capital allocation rather than risk an embarrassing defeat at the annual meeting. This private engagement process has become the primary channel through which asset managers translate voting power into actual control. The board, in turn, hires and fires the chief executive and approves all major strategic decisions, completing the chain. A minority voting position becomes effective ownership of corporate direction without the need to own factories, stores, intellectual property, or even a controlling economic stake. The implications extend beyond individual companies to entire sectors. When the same 3 or 4 asset managers are simultaneously the largest shareholders in every significant competitor within an industry, airlines, banks, pharmaceuticals, or consumer goods, they possess the ability to impose parallel governance standards across the industry as a group. Prices, capacity decisions, wage policies, and public positioning tend to converge, not because of explicit illegal collusion, but because the same stewardship teams apply the same voting guidelines to every portfolio company. The result is a form of horizontal influence that operates through vertical control of each separate corporate board. Part 2. The self-reinforcing architecture of cross-ownership and reinvestment. The largest asset managers are not merely external investors in operating companies, they are deeply intertwined with one another through reciprocal shareholdings. Vanguard is typically the largest shareholder in BlackRock. BlackRock is among the largest in State Street, and State Street in turn holds substantial positions in both. This circular ownership structure creates powerful incentives for coordination rather than confrontation. No institution wishes to vote against the management slate or strategic priorities of a company in which its peers, and effectively itself, have a vested interest. The stewardship teams therefore tend to reach similar conclusions on most proxy questions, producing the observed phenomenon of near-unanimous voting among the major passive managers. Revenue streams further entrench this architecture. Management fees, securities lending income, and in BlackRock's case, technology licensing fees flow into the publicly traded or mutually owned parent entities. These profits are either distributed as dividends or reinvested, and because the asset managers themselves are large-cap companies included in broad indices, the capital returns to the same concentrated pool of equity holdings. Each year, therefore, the relative voting power of the major managers increases almost automatically, even when markets are flat or declining, because new investor contributions continue to purchase additional shares in the indices. Market downturns paradoxically accelerate the process. As prices fall, the same dollar inflow purchases more shares, and the percentage of votes controlled by the index giants rises further. Banking relationships complete the loop. The largest commercial and investment banks serve as custodians, prime brokers, and securities lending counterparties for the asset managers, while the asset managers are in turn among the largest shareholders in those same banks. This symbiosis generates hundreds of millions in annual revenue for both sides and creates additional disincentives for disruptive proxy voting. The entire structure thus operates as a partially closed system in which fees and lending income are continuously recycled into greater voting control over the corporate sector. Part 3. From voting power to industry-wide and cultural uniformity. The concentrated proxy voting power of asset managers translates directly into the ability to shape not only individual companies, but entire industries. When the same institutions vote 25 to 35% in every major airline, the industry rapidly adopts similar capacity discipline and pricing policies. When they occupy the same position in every large bank, credit standards, fossil fuel exposure, and diversity reporting converge. Academic observation has confirmed that sectors with high common ownership exhibit higher prices, lower output, and reduced wage growth compared to theoretical competitive benchmarks. The mechanism is not secret conspiracy, but the simple application of uniform voting policies across thousands of companies by a small number of stewardship teams. Beyond economic variables, cultural and political uniformity has emerged as a prominent outcome. Corporate mission statements, public advocacy positions, content moderation frameworks in technology firms, and employee resource group structures now display striking similarity across firms that once prided themselves on distinct identities. This convergence occurs because the same asset managers insist on comparable environmental, social, and governance metrics as conditions for continued support of incumbent directors and management compensation plans. A board that resists risks, seeing a quarter of its votes withheld or redirected to dissident candidates, an outcome few are willing to court. The process extends to mergers, acquisitions, and capital allocation. Large asset managers routinely signal approval or disapproval of proposed transactions through their voting intentions, effectively granting or withholding permission for major corporate restructurings. They may encourage cash retention for sustainability initiatives rather than dividends or share repurchases, or they may support private equity buyouts that remove companies from public scrutiny while preserving their own influence through investments in the acquiring funds. In this manner, Proxy voting power becomes a tool for directing the evolution of entire industrial landscapes. Part 4. The paradox of retail investor complicity and its consequences. Individual investors continue to allocate ever larger portions of their savings to low-cost index funds and ETFs managed by the dominant asset managers, attracted by historically superior risk-adjusted returns and minimal fees. This behavior is entirely rational at the personal level. Over 15 to 20-year horizons, broad index funds have outperformed the vast majority of active strategies. Yet the same rational choice aggregates into a collective outcome that harms the very investors making the choice. Household savings are transformed into permanent voting rights exercised by centralized stewardship teams pursuing institutional objectives that may diverge from, or directly oppose, the economic interests of the underlying beneficiaries. The costs appear outside the quarterly brokerage statement. Higher consumer prices in concentrated sectors, reduced product variety, suppressed wages in labor markets with common ownership, and the imposition of uniform social and political positions on companies all represent transfers from citizens and consumers to the rents captured by the concentrated ownership structure. Retail investors enjoy marginally higher portfolio returns while paying substantially higher real-world costs in the form of diminished competition and choice. The asymmetry is exacerbated by the fact that market declines offer the asset managers an opportunity to increase their relative control at bargain prices, while individual investors experience genuine financial pain. Thus, the system is sustained by the track record that it itself helps to create. As long as equity markets continue to rise on average, an outcome partly supported by the incessant passive inflows, the virtuous circle for asset managers remains unbroken. New generations entering the workforce and opening brokerage accounts repeat the same decision that consolidates still greater power in the same few institutions. The small investor secures the appearance of safety and diversification while involuntarily financing a structure that progressively reduces both competition and pluralism in the real economy. Conclusion: common ownership exposed, how index funds shape prices, wages, and culture. The concentration of proxy voting power in the hands of a small oligopoly of asset managers represents one of the most significant yet least understood shifts in the history of corporate governance. What began as a consumer-friendly innovation, low-cost passive investing, has inadvertently recreated a degree of centralized economic control not seen since the era of Morgan and Rockefeller, only without the visibility or accountability of personal ownership. A minority of votes, reliably exercised by a few dozen stewardship professionals, now determines who sits on thousands of corporate boards and, through them, the strategic and cultural direction of the operating businesses that employ millions and serve billions. The architecture is remarkably resilient. Cross-ownership among the managers themselves, reciprocal banking relationships, and the automatic reinvestment of fees into the same pool of large-cap shares create a flywheel that increases voting power year after year with minimal external capital. Market crashes, far from threatening the structure, accelerate consolidation by allowing the purchase of additional influence at depressed valuations. Individual investor behavior, perfectly rational in isolation, supplies the fuel that keeps the machine turning. Ultimately, modern boardroom capture demonstrates that effective control over corporations no longer requires bricks-and-mortar assets or even majority equity ownership. It requires only the disciplined command of enough proxy votes to decide who governs the board, and the board, once aligned, governs everything else. In the passive index era, a handful of financial institutions have achieved precisely that command, reshaping industries, culture, and economic outcomes through mechanisms most citizens never see and few fully understand. The result is a new form of concentrated power that operates legally, quietly, and almost entirely on autopilot. Thank you for listening to the Real Free News Podcast. Be sure to like, share, subscribe, and tell us what you think in the comments section. Visit realfreenews.com for more Real Free News, and check out the Real Free News store for real free food and gear. Remember to keep it real, free, news, and we'll see you next time.